Welcome to Module 1, Chapter 1, Financial Accounting. What we're going to do in this module is we're going to learn some terms, some qualitative and quantitative characteristics, and some basic principles that help facilitate the preparation of financial statements. At the end of this module, you should be able to prepare 3 of the 4 financial statements: an income statement, a statement of retained earnings, and the balance sheet, and also be able to understand why we do certain things when we prepare them and what the theory is behind the financial statements. I'm looking forward to sharing this information with you, and let's get started. So let's go ahead and get started. The purpose of accounting is to, 1, identify, measure, and communicate economic information about a particular entity, or, in other words, a company, to interested users. One of the things that we say is accounting is actually the language of business. So what you're going to do is you're going to identify some accounts and numbers, you're going to measure them, and then you're going to communicate your findings through the use of financial statements. Here's some terms that will be used throughout this chapter and many chapters to follow. Terms like assets, which is a resource of a business, liabilities and equities, are used to identify and describe economic information and are part of what we call our conceptual framework. So if we go down this list, we have an asset, which is a resource of the business. An example of an asset would be cash. It is reported on the financial statement that you'll see later, what we call the balance sheet. A liability is an obligation of the business. It also will be put on the balance sheet, and you will learn that when I do the actual working of an exercise. Equity, the difference between assets and liabilities, is also found on the balance sheet. Contributed capital is equity resulting from contributions from owners. In other words, when owners contribute money or they leave their earnings in a particular company, and that's also found on a balance sheet. Another title used for contributed capital is common stock. The retained earnings is equity resulting from profitable operations. It's found 2 places, on the balance sheet and the statement of retained earnings. Revenue is an increase in the assets or a resource of the company resulting from selling a good or providing a service. It is found on the income statement. The expense is a decrease in assets, so a decrease in cash, from selling a good or service. So in other words, it's paying your rent, paying your utilities, and that's found on the income statement. A dividend is the distribution of profits to the owners, and that will be found on the statement of retained earnings. Now, these will be 3 financial statements that you will prepare: the balance sheet, the income statement, and the statement of retained earnings. Right now, we're just getting familiar with some terms regarding this economic information and some principles that help guide us in the preparation of the financial statements. So what are some of those principles? There are 3 principles that we'll be using when we measure economic information. One of those is what we call the revenue recognition principle. This simply stated says that revenues are recorded when they are earned. What is the ramification of that is that the receipt of cash is not required to record revenue. So how I like to put the revenue recognition principle is that we record revenue when earned, whether received or not. So the act of you performing a service like mowing a lawn, the fact that the neighbor isn't going to pay you till the first of the month or the end of the month, does not preclude you from including that service or that amount of money that you charged her in your financial statements. So revenue recognition is we record revenues when earned, whether or not we have received the cash or not. The flip side of that is the matching principle, where we record expenses in the time period in which we incurred them. In other words, when we used them, no need to even pay them to include them. They are incurred to help us generate revenues. So what this means is that we record expenses when incurred. So I like to put the revenue recognition and the matching principle together. And what I say is, and what I think is easier for you to understand, is that we recognize revenue when earned, whether received or not, as well as the expenses that help generate that revenue, whether we've paid them or not. And so that means that we record expenses in the period in which they help us generate the revenue. Cash does not have to change hands for us to record these figures in our financial statements. When we talk about the third principle, which is the cost principle, its assets are recorded and maintained at what we call their historical costs. And what that means is it's only what we actually wrote the check, so what we actually paid for it. So let's give an instance of this. Let's say we're going to buy a building. The people were asking $1 million for the building. The taxing authorities gave a value of the building of 1.2, and the people we bought it from accepted a bid from us for $800,000. So you have three different values. You have 1.2, 1 million, and 800,000. The only one that will get recorded is what you paid for it. In our case, in that example, would be the 800,000. So assets are always recorded at what we call their historical costs. And all three of these are an integral part of what we call the accounting conceptual framework. So we always are going to make some assumptions. So the assumptions that are used by most accountants when communicating economic information are important elements of what I call the conceptual framework. These assumptions include the following. One is the economic entity. So what that means is that the financial activities of a business can be accounted for separately from the business owners. So that means we don't blend the two checking accounts of the owner. So if you're owning that lawn mowing business, you need to keep track of the lawn mowing revenue and the lawn mowing expenses separately. So that's what the economic entity means, is that the financial activities of that entity will be accounted for separately. The second one is what we call the monetary unit, and simply stated is we're going to record that in the dollar. We're not going to adjust for inflation, and the best means of communicating accounting information in the U.S. will be using the dollar. Now, if I'm in Europe, then it's going to be the euro. If I'm in Great Britain, it's going to be the pound. If I'm in Russia, it's the ruble, and so forth. So that monetary unit will be that monetary unit that's used in that particular area in which you are. So for here in the United States, it's the dollar. The third item is what we call the time period assumption. So accounting information can be communicated effectively over what we call short periods of time. What that means, it could be for a month, it could be for 3 months, it can be for 6 months, or it can be for 12 months or a year. So we can communicate accounting information over what we call short periods of time. When we work for time period, there will be two financial statements that we'll prepare, the income statement and the statement of retained earnings, in which we communicate that information of what we call over a period of time. for the 1 month ended, for the 3 months ended, for the 6 months ended. When we do the balance sheet, it's what we call in a point of time, as of December 31st, as of June 30th. We call that the time period. Now, last but not least, sometimes it's difficult for students to understand this assumption. It's what we call the going concern. And frankly, what this means is when we look at a company for which we are doing the accounting, we assume that the operations of that company will go on indefinitely. So we say that that company is a going concern. It means that that entity will not be selling its assets. It will not be closing up shop. It means that the company for which we are accounting will continue its operations indefinitely. So we make 4 assumptions when communicating economic information, when we're putting together our financial statements. Okay. Next, we have both qualitative and quantitative characteristics in the accounting information. So first, we're going to talk about understandability. And so what that means is that accounting information should be comprehensible by those willing to spend a reasonable amount of time of studying it, which is why we're here, is so we can understand people's financial statements. And what that means is that users must spend some amount of time studying that accounting information if they're going to understand what it is it's telling them. Remember, accounting information is telling a story. Then that information that we provide also has to be relevant. So it has to have relevance to the users of those financial statements or of the accounting information. So the capacity of accounting information to make a difference in decision making. So what we're looking at, what we're reading, has to be relevant or predictive to any feedback value that I might have. It must also be timely. If I'm getting my financial statements a year after it, I can't go in fact change. And so they also need to be relevant as well as timely. Accounting information needs to be reliable. If I can't rely on this financial statement, if I don't assume that the information is free from error, then I have an issue when I'm communicating this information, and I could be giving false information that will have people make the wrong decisions. So the extent to which it's possible, accounting information must be depended on to represent what it purports, both in description and the numbers. We've had a problem in the accounting profession with reliability, where we've reported one thing and then a company's turned around and gone bankrupt because there was fraudulent activities. And we'll learn somewhat about that when we study our ethics portion of the semester. So in this particular case, they have to be reliable. We also have to be able to compare them. The ability to use accounting information to compare or contrast financial activities of different companies is really important. And that's because we want to be able to not only look at our company 1 year to the next, but we want to be able to compare ourselves to the competitor to see if we're in the ballpark with what they're presenting financially and get an idea on how we can compete with them. So it's very important that we look at those characteristics of the accounting information. And so let's just go back one slide to where we talk about that they need to be understandable, they need to be relevant, they need to be reliable, and we have to be able to compare them. We also look at 2 more, which is consistency. Accounting information should be comparable across different time periods within a company. Consistency specifies that information needs to be comparable across these different time periods within a company. Materiality presents guidance about the threshold over which a financial item could begin to affect your decisions. So in Hewlett-Packard, I had come from a company where there was a $100,000 discrepancy, and that was like Armageddon to them. I mean, $100,000 was a lot of money. Well, to HP, I looked and looked one time for an adjustment, and I couldn't find it. And my boss says to me, well, how much are you off? I said, well, I'm off $50,000. And she goes, oh my God, the materiality threshold's $1 million. It's like, oh my God, you're kidding me. And so materiality can vary from company to company. The last of the qualitative characteristics is conservatism. This guides accountants toward the presentation of the least optimistic alternatives when uncertainty exists. And what that means is we'd rather state it low and come in high than state it high and come in low. And so when we use conservatism, we're always going to go for underreporting opposed to overreporting. And that's what it means. So you want the least optimistic alternative if uncertainty exists. Now, here's what the financial statements are that we'll be preparing. The balance sheet shows a company's assets, liability, and equity at a point in time. The structure is assets equal liabilities plus equity. And I have another video that you'll be watching where I actually go through the format and work out several problems with you before turning you loose to your own vices and working your own problems. The income statement shows a company's revenue and expenses over a period of time. The structure is revenue minus expenses equal net income or loss. You have a net loss when expenses exceed revenue. We have the statement of retained earnings. It shows us the changes in the company's retained earnings over a period of time. We start with beginning retained earnings plus net income or loss minus dividends equals our ending retained earnings. And then the fourth financial statement that you won't be covering in this module or this class is what we call the statement of cash flows. If you are in my Business 504 class, then you will cover the statement of cash flows in several weeks. If you are in the Accounting 210 class, you will not cover the statement of cash flows until Accounting 220. I actually feel that the statement of cash flows is one of the most valuable statements that you can give to an owner of a business. And the reason is it shows the company's inflows and outflows of cash over a period of time. This financial statement used to be called the statement of sources and uses. So how you got your cash and then how you spent your cash. And that's all for today. So the next video that you can go ahead and watch is the actual working of preparing the financial statements using some examples from the textbook, and then you'll be ready to go do some problems on your own.